This shows a picture of our digital credit stack over the past 12 months. You can see when I spoke here a year ago, none of this existed. Right? What caused this to exist? Necessity is the mother of invention, opportunity in the form of capital and intelligence, not mine, AI, digital intelligence. I argue with the AI and I fight with it, and we learn very, very quickly, and I can get answers that would take 37 accountants and lawyers a month, and I can get the answer in 10 minutes, and so I can iterate something like 100 times faster with AI. So the liquidity in these things has gone from 70 million to 180 million in a few weeks. And let me try to illustrate this a different way. The preferred stock market has normally been a garbage market. Most of these securities are garbage. They go into a portfolio and people wait to die. They're sold via 144A transactions, which means that it's illegal for the public to buy them unless you're a qualified investor. When they're sold that way, they trade 100,000 a day with a bid-ask spread that might be 300 basis points wide. If you take one public, they trade 1 million a day. The first set of digital credit instruments we created traded 20 million, 20x that. And then when we finally got it right with Stretch, it trades 100x that. And this is 12 weeks old. So our goal here is to get this to 1 billion a day. And it's a chicken and the egg thing. Like, why would I want to trade it? Well, you know, if it's a heterogeneous, low-yielding instrument, there's no reason to buy it. There's no reason to trade it. Because these are perpetual, they're going to last forever. That meant that we could put a shelf registration on them, and we could grow the AUM in the same way that you might grow a proprietary credit ETF. And that was always our vision for this. Now, we discovered that putting Bitcoin together with preferred stock, together with an IPO, together with a shelf registration was an innovation. But then we tripped over this next point, which is we discovered that all the dividends that we pay out are tax-free for you, right? Tax-deferred, technically. Basically, the bug was, oh, you're funding the dividends by selling equity, and you don't have cash flows to fund the dividends. Well, the fact that we fund the dividends with equity means that it's return of capital, which means that all the dividends become tax deferred. And that means that you don't pay New York City tax, you don't pay New York State tax, you don't pay federal tax. You just get the dividend, and the basis in the instrument is reduced. And so a ROC dividend is 0% effective tax rate until your basis goes to 0. Then it becomes like a qualified dividend, which is a long-term capital gains tax. And what it isn't is interest income, which is what every bond would be and every money market or every bank credit instrument would be. We thought about it, and then first we thought, well, is this true for all the instruments? And then we said, why is it true? And then it's true because we don't generate substantial earnings and profit, E&P. And then we thought, well, will it continue to be true? And then we thought, well, yeah, the credit's the product. This is going to be true forever. And so the business model is an interesting one. It basically is a triple tax deferred business model once you understand it. And so you sell the credit creates the amplification on the equity, and that's what actually creates the equity value. The more credit you sell, the more Bitcoin per share you create, and that's how you outperform Bitcoin. And the trick is, people have known you could do this, but the trick is to do it without credit risk. So, if I go and I borrow money for 12 months, then I've got a massive credit risk. 5-year money is a credit risk. But if you borrow the money with intention to never pay it back, there's no credit risk. How do you borrow money with intention to never pay it back? You sell preferred equity. So I would love to tell you that I just sat down and we invented this digital credit, but the truth is we stumbled upon it because we kept running into headaches or problems we wanted to solve. And we created digital credit because we started with digital capital. We started using Bitcoin as the collateral asset. And so most credit's based on a depreciating asset. And Bitcoin is appreciating asset. So if you build on top of an asset appreciating 10, 20, 30% a year, the credit risk is falling exponentially. That's the first breakthrough. The second breakthrough is it's transparent, homogeneous risk. When you have a credit instrument based on 87,000 home loans, you've got heterogeneous risk. You've got discrete risk. You know, you might have hurricane risk. You might have fire risk. You might have political risk. Corporate credit, sovereign credit, bank credit, they all have opaque, heterogeneous, discrete risk. But on the other hand, Bitcoin's transparent, homogeneous, continuous. On our website, we update the credit model every 15 seconds. Right? You can literally go plug in the price of Bitcoin, your volatility forecast, your performance forecast, anything, and you can get the credit model to spit out in seconds. And that's a breakthrough. You cannot do that with mortgage-backed securities. You can't do it with junk bond portfolios. You can't do it with any kind of commercial real estate portfolio. The third big innovation is digital credit. In this particular case, it's digital credit is based on equity, not based on debt, right? Bank credit is bank deposits are liabilities. The bank has to give back the money. And they're the worst type of liabilities because they're overnight liabilities. You have to give back the money on demand tomorrow or today. Whereas debt is a liability that you got to give back. You got to give back the money in 1, 2, 3, 4, 5 years. The normal duration of corporate debt is like 4 years. So it's 4-year money. But preferred equity isn't a liability at all on the balance sheet. It's an asset. It's an equity instrument. It doesn't amplify the risk. It mitigates the risk. So if you've raised $10 billion of preferred equity, you're never giving it back. There's no $10 billion principal refinance risk. You've got a dividend, but the dividend is a shock absorber because literally the definition of preferred equity is the company's board of directors can't approve the dividend if it would put the company in peril. And so when you're actually funding with preferred equity, you're putting an asset on the balance sheet, a mezzanine equity asset. It mitigates the risk. And then of course, not all preferred equity is equal. You could have a refinance or a put obligation embedded in the preferred equity would make it shorter duration. But if you make it perpetual preferred equity, then the capital is permanent. And if it's permanent, that means you're not going to have any credit default event, not in 5 years, not in 50 years. And those are all reasons why you might want to do that. But of course, the next thing to do is take it public. And so most credit, if you think about private credit, it's illiquid, it's unbranded, it's local, it's difficult to access. But public credit, it's STRC, it's stretch, it's got a name, it's stride, STRD, it's got a name. It's global, it's branded, you advertise it, friends tell their friends about it. People go tell their mothers, their fathers, their sisters, their workout partners, you should buy some of this. It's easy to access. There are 4 credit instruments you can buy on Robinhood. They're STRF, STRC, STRD, STRK. There are credit instruments. So this idea that you want to actually take it public is a big idea. Now, how do we learn that? Well, we learned it by watching our own convertible bonds not trade in the market. We had equity trading $4 billion a day, and we had convertible bonds not trading for 3 days. And it occurred to us that there's something not right about that market, and we wanted to fix it. And the way you fix it is you take the things public. And then the other point that I make is digital credit is better because if you buy $100 million of digital credit, we can sell it to you in 30 seconds, and we can create it. We create the backing collateral for the credit in real time. So if we get $1 billion of credit orders, we create the $1 billion of collateral and we stay synchronized. You can't create $1 billion worth of home mortgages overnight. You can't create $1 billion worth of commercial loans overnight. So you cannot create conventional credit and synchronize it in the same way that you can create digital credit. That's why, you know, banks have, you know, 50-story buildings and 27,000 employees. We can create billions of dollars of credit with 6 people. It can be $1 billion, it could be $10 billion, it could be $100 billion, it can be $1 trillion. Still the same 6 people. It's extremely efficient, instant, automated. And when you put all that together with the last observation, which is it's tax-deferred income, this is how you go from a 2 or 3% yield to a 20% yield, right? Those are the innovations that make digital credit. And here, you know, the fortunate happenstance is we just discovered the Bitcoin treasury model. The treasury model is just triple tax deferred. We raise billions of dollars of capital by issuing securities, that's tax deferred. We generate billions or tens of billions of dollars of income through appreciation of the asset, tax deferred. And then we can pay billions of dollars of dividends as return of capital, tax deferred. Rinse and repeat. I would say that we have inadvertently created the most scalable, tax-efficient fixed income generator in the world. The digital treasury model is the most tax-efficient generator of fixed income. If your goal is to generate large amounts of after-tax or tax-deferred fixed income, and by the way, who would want that? Like everybody? If that's your goal, then this is the way to do it. There's no other company that's going to tell you they could generate $100 billion of dividends tax-deferred as rock dividends. They can't do it. If you look at the entire structure, return of capital dividends, they've been utilized, but normally by pipeline companies and real estate companies and oil and gas companies, and they're basically using depreciation credits in order to get to negative E&P. And you cannot, maybe you can pay 3% dividends, and maybe you can pay 3% against a very fixed amount of physical capital. But there's no way to pay 10% dividends and to grow the business 20, 30, 50% a year, because the physical capital won't support it, the depreciation won't support it. So to do what we're doing at the scale we're doing and grow the way we're doing, it has to be digital. So what is it we are? We're basically a digital credit factory. The way to think of it is credit investors want US dollar yield, and then equity investors want BTC yield. So we're doing a perpetual swap. We're swapping, I'm going to give you 10% US dollar yield forever, and I'm going to take back the Bitcoin, which is an X% BTC yield forever. And since the equity investors want the Bitcoin per share, and then the credit investors want the yield, everybody gets what they want. And because we do it with preferred equity, we do it without credit risk. And so if you've studied the swaps market, you can see what's going on here. Now, we just started doing it in euros. So obviously half the world wants to use dollars, but there's a big market for euro yield, there's a big market for JPY yield, and so you can apply this pretty much in any currency. How important is it to pay rock dividends? Well, if I take $100 and I pay 10% dividends on $100 and your tax rate's 50%, you have $164 after a decade. But you can see that when that tax rate goes to 37%, you're 14% up. When they become qualified dividend distributions, you've got 35% more money. And if you've got rock dividends, you've got 64% more money. So it's pretty substantial to any retail investor or small business. So what are the digital credit opportunities? Well, this is stretch yield versus other credit instruments. And what you see here is that even if you don't pay taxes, stretch is twice as good as most everything else. And if you're a taxpayer in Miami Beach, it would be 4 times better than your money market. And of course, if your bank's going to pay you 40 basis points, but I'm going to assume you're smart enough to move your capital into a money market and get paid 400 basis points. But ultimately, the best thing going is private credit, which is going to be that illiquid, opaque idea. And this is going to be much better than that. And this is, again, trading plus or minus a few cents right now. Now, to make this a little bit more personal, I've actually calculated the tax equivalent yield in New York City for you that live in New York City. It's 21.8%. So stretches a bank account that pays you nearly 22% tax equivalent yield if you're a New Yorker. It's about 21% in LA or San Francisco. If you live in Miami, it's 16%. But if you're saying, or you're asking, why would I want digital credit? I think the chart's illustrating why you're going to want digital credit. This is that story in Europe, right? Stream is a 12.2% effective yield. The money markets are 1.5%. A 10-year euro credit instrument is 2.6. So you're talking about 1,000 basis points more than the 10-year index in Europe. You could fund in euros, buy Stream, and capture a 10% carry trade. Right? Who's going to do that? Well, I think a lot of people are going to do that once. Here, you have to come to two conclusions. You have to decide Bitcoin's not going to zero tomorrow forever. Do you trust Bitcoin? And then you have to trust the company strategy, right? So if you trust the issuer and you trust Bitcoin, then this is like free money, right? And it's staring at you if you want the carry trade of carry trades. This is the tax equivalent yield in the major cities in Europe. 23% in Vienna, right? And I put the money market fund over there for reference, just so you see. The status quo is the little green dot on the right side, and this is what the digital economy is going to bring to Europe over time. The summary of all this, right? I mean, the message is digital credit's just superior. It's superior to corporate credit, conventional credit, mortgage-backed credit. The credit's a $300 trillion market. As people start to think, well, maybe I'd like to get double, triple, or quadruple, you're going to see 1, 2, 3, 4% of that market change. This is a snapshot of the risk-free rate in every currency in the world. And what you can see is the US dollar is the highest risk-free rate. But, you float over here to Europe, you're 1.9, 1.8%. In Singapore, it's 1.4%. In Japan, you're 50 basis points. In Switzerland, you're minus 40 basis points or something like that. So what is the idea with digital credit? It's very simple. You sell a treasury credit instrument, you convert it into currency of choice, you strip the vol off of it, and you hand someone 600 basis points or 800 basis points more than the risk-free rate. Right? What is the ideal product? The product that is felt to be useful by the people of the world. Okay, well, what do people find to have value? Well, there's a word in the English language for something that everybody finds valuable. It's called money. That's the word, right? If you actually generate 600 or 800 basis points of additional yield in the currency of choice, you have created the perfect product. Well, what is the perfect product? It's the product that someone is deaf, dumb, blind, in a coma, yet unborn, would still find valuable. Right? I thought the iPhone was the perfect product at a point, but I'm on the iPhone 17 Pro Max. There's 35 versions. We're going to be in the iPhone 137 by the time your grandchildren are born. But you put something like this in a portfolio, it's going to work for them whether they know it or not. So I'll just end with this. Right? What have we done? Well, we've created an equity, and if you want enhanced exposure to digital capital and digital credit, you buy the equity. That's how you get the amplified roller coaster. And if you're the equity investor and you want that kind of amplification, you buy it. If you don't trust anybody, if you want no counterparty risk to a company or no currency risk, buy Bitcoin. Bitcoin is the index on the crypto economy. What does that mean? It's the index on the free market economy. If you want to buy the free market capital index, you just buy Bitcoin. It is the risk-free rate for a person that believes in digital assets and the digital economy. If you want to have your cake and eat it too, you buy something like Strike, a convertible preferred. It gives you a guaranteed dividend, some portion of upside, consistent income, and principal protection. If you want to maximize cash flow, you buy one of the high-yield instruments like STRD. It's 13% tax deferred. if you don't quite trust the company and you want to make sure that you've got some investor protection and some penalty if they try to skip a dividend, you buy the senior instrument like Strife or Stream. And if you simply want to strip all the volatility away and just get something much better than your bank or your money market, you would buy the Treasury credit instrument. Now, if you're not sure what you want right now, I will tell you what you want. What you want is you want this Treasury instrument that is basically a high yield bank account. You want to be paid 10.5% with the tax deferred for the next 10 years, right? When you change your mind, you sell it for the same price you bought it and you go do something that gets you something better. But you know, at the end of the day, I know a lot of Bitcoin maxis, a lot of Bitcoin believers, there aren't very many of them that would say, I'm going to actually put all the money I need to pay my kids' tuition in the fall into Bitcoin. They all have treasuries. They all have near-term obligations. And if your choice is to get 30% ARR with more than 30 vol, or to get 10% tax deferred with no volatility, there's a lot of people that would put some portion of their money into that no volatility 10% guarantee. You know, it's pretty compelling, especially if you can borrow the money at 4 and you can get into the carry trade. So with that, I would thank you for your time. And I would just say, I think if you're a financier and you're an investor and you think really hard right now, what I've shared has implications for every company that has digital assets on its balance sheet. It has implications for equity investors. It has implications for credit investors. And the only thing I would say is it's worth thinking hard about. We say Bitcoin takes 100 hours to understand. That's a 15-second ad. It doesn't take even 100 seconds to understand, oh, a bank account that pays me 10% and I don't get taxed on it, right? That's like, oh, too good to be true. What's the catch? But just like a lot of people don't want to play with fire or explosives, they all would like a car with an automatic transmission that's got fire and an ignition inside it that will take them here. So we are now on the verge of being able to create some wonderful financial instruments that will appeal not to the crypto maxis or the innovators or the tech investors. It's, the mission is give 1 billion people 10% tax deferred, right? Everywhere in the world. And it's kind of cool in the US, but if you live in Switzerland or Japan and you're getting 50 basis points or less, there's a difference between nothing and 10% return on your capital. It's a revolution in finance. And I think in the last 12 months, my eyes have been opened and I realized that our mission is to go and digitally transform the entire credit marketplace, which means the banking industry and all of finance, and we can do it everywhere in the world on a strong Bitcoin-based foundation. Thank you.